Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 28th of March. I'm Daniel Lam, your host for the podcast. If you ask an investment strategist to name one key single driver for risky assets, then the US dollar is likely to be one of the prime answers to this question. Since we spoke about the recent pullback in the DXY in yesterday's podcast, let us dig deeper into the US dollar today by taking a closer look at the health of the US economy. The current issues in the financial sector, even though is unlikely to result in a systemic crisis, is likely to tighten financial conditions and credit availability, which may result in downward pressure on US economic growth. Now, consumers had largely maintained their spending habits on the assumption that the labor market has been strong, and you can easily find employment if you lose your job. But those assumptions are likely to change as banks retreat further from lending and tighten lending standards. Any signs over the next 2 quarters that the FOMC is prioritizing inflation fighting over supporting the economy with swift rate cuts may encourage a further consumer retreat. Therefore, in order to restore confidence, the US government needs to show to consumers and small businesses that the deposits are safe. Small business surveys have already been under significant pressure since 2021, as surging input and financing costs, combined with increasing tight labor markets, put pressure on margins. This may start affecting credit spreads eventually. The US dollar has benefited consistently over the last 10 years from both an economic growth premium and an interest rate premium over many of its peers. The current issues with the economy is threatening these premiums. Hence, we believe the US dollar is likely to fall from here, resuming the downtrend that started in October last year, which was paused since December. Further, the US dollar's strong negative correlation to risky assets appears to be reversing, leaving the US dollar less susceptible to squeezes higher during periods of risk aversion. Technically, the DXY may retest support levels at 101.92 and 100.82. Now, if these levels do break, then it may open the way to test lower support at 97.69. On the upside, resistance lies at 105.10. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.